What is the one single one characteristic that has made Warren Buffett successful? It's been his purposeful detachment from all things that are the stock market. He owns a business, and that's all he thinks about. What Warren doesn't think about, we're all consumed with. What he does think about, businesses, we don't spend enough time thinking about.
So I first got the chance to chat with Robert back in October of 2023, and we had such a good conversation where we just talked about literally a bunch of your books, and it was really, really fun. But today, seeing as Berkshire's kind of coming up, I want to discuss one book that you're really well known for, which is The Warren Buffett Way. So by the time that this episode is released, the 4th edition of your book is going to be in stores. And I got my hands on a pre-release of the book, and I enjoyed it very, very much. So I want to kick off the conversation by discussing some of the lessons from Buffett's first ever investment, which was Citi Services Preferred. So this investment taught him the importance of one of his greatest attributes, which is patience. So I think Buffett probably already had the makeup of patience at this time, but he hadn't had the opportunity to express it in the stock market, as this was his first experience. So I'm interested in knowing a little bit more about if you think Warren has learned his most valuable lessons from his own mistakes, or if he's learned them from learning from others.
Well, I think it's a combination of both, Kyle. I think, some of the, you learn from your mistakes, but hopefully you're learning how to be successful from others. I mean, his dad was a stockbroker, and we can fast forward, 10 years and Ben Graham, we'll do that, I'm sure, later in the show. But clearly, I think the lesson that he learned at Citi Services Preferred was the mistake that he was forced to make because he had pooled his money with his sisters, Doris and Bertie, and to buy some Citi Services Preferred. I think he bought 3 shares, and the stock was $111 or something like that, and it subsequently started to go down in price, and his sisters were just losing their mind. Just, Warren, this is terrible. I can't believe you lost all our money, and they're, like today's equivalent of how clients treat their financial advisors from time to time, have just totally lost their mind. Now, never mind that we're in the middle of World War II. And, as Warren said, the front page of the newspapers never had good news, and the market was dealing with, the outcome of the war and stuff like that. But he said he finally just basically had to sell the stock because he couldn't take the harassment anymore from his sisters. And he made just a little money, not a lot. But had he held on to it for, I think, another year or 2 years, he probably would have tripled his money. And it finally just said to him, I can't live like this. I can't, people either yelling at me and screaming at me about it, or he said, I was a capitalist at a young age. His dad really, we talk about this in the new book, his dad being a libertarian, a congressman, a big believer in the United States of America, that, don't bet against America in the long run. It's going to work out. I think that was deeply grained into his psyche, even at that young age. And so I think, patience was something that he learned early in life, even though he didn't have the methods from Graham yet. He did learn that, just hang in there and eventually everything will be okay. That was kind of the first lesson.
I liked how you pointed out that his sisters were just going crazy. I mean, that's probably something that you have to deal with on a pretty regular basis.
Every night at the dinner table, Warren, you're losing our money. I can't believe it. The stock is down. I mean, how many days after days can you take that beating? You just can't take it anymore.
Exactly. So one of Warren's biggest mistakes, other than buying the original Berkshire Hathaway textile mill, was Dexter Shoes, a business that he bought in 1993. So when I first researched some of Buffett's mistakes, this one really stood out to me, just because not only was it not necessarily a good investment, but he also used Berkshire stock to purchase it. So my most significant insight from this mistake was that whenever you buy a company, you should be trying to ensure that the business can't be decimated by low-cost competition. But there was an excerpt from your book discussing the Berkshire textile mill in the 1980s. And it also talked about how the Berkshire textile mill was actually getting a little bit worse, and that was also due to foreign low-cost competition. So in some ways, Warren kind of made the same mistake twice with the Dexter Shoe acquisition. So I'm just interested in knowing a little bit more about how you think he's fared since then in terms of, not repeating similar mistakes.
Well, I'll let you ask Warren that question. That's what you see. I don't want to bring it up, but you're right. I mean, the way that which you phrased the question, having that painful lesson of Berkshire buying the textile mill, and it was very painful for him to, finally shut it down. He said, as long as they can at least earn a modest amount of profit, I won't shut it down, but neither will I fund it from the profits of other businesses at Berkshire to keep them alive. And eventually just got to be to the point that it was just a money losing operation. So yes, he would say the first mistake was buying Berkshire itself. That was a bad business, as Charlie Munger pointed out, and Warren so warmly wrote about Charlie in this year's annual report, and the tribute to Charlie as the architect. Like, now that you bought Berkshire Hathaway, never buy a company like this ever again. But you're right. I mean, Kyle, very good observation. You think about Dexter Shoe, and the double pain or the double, slash on the back was not only did he buy a bad business, but he used Berkshire stock. And that is a double painful whammy. I don't know. Kyle, you've asked a very good question. I don't know. Obviously, he must have had pressure from the owners of Dexter Shoes that they didn't want a capital gains transaction, so we'll take the stock in kind, which worked out swimmingly well for them. I mean, they became very rich off Berkshire stock, even though Dexter Shoe went to a zero. But you're right. A good point. I mean, foreign competition for the manufacturing of shoes versus, making shoes here in the U.S. You would have thought he would have seen that one. I don't have a good answer, but you have a very good observation. And it's even more when I think back to Berkshire, and Warren's talked about this before. He said, instead of rolling the $25 million into Berkshire Hathaway, that then subsequently bought National Indemnity, of which, I own less than 40% of the business. Just think if I would have rolled the $25 million into National Indemnity and never owned Berkshire, and I would have had 100% of National Indemnity, what kind of world that would have turned into. So very good observations. I wish I had a good answer for your audience, but I don't know. You might just say, he missed on that.
One question I had for you, seeing as you obviously studied Berkshire in a lot of detail, is on the insurance float area of things, and using insurance companies as kind of an investment vehicle, as just because that float in the right hands, like with Warren Buffett, is just like magic, right? But a question I've had is why don't more insurance companies take advantage of hiring like a really, really good investor to manage their float? Because it just seems like such a home run, but it kind of seems like a lot of them are just investing in bonds or other assets that are barely beating inflation. So I'm just interested in knowing, getting your insights on that.
Well, yeah, and you think about Lou Simpson at GEICO doing the same thing. My first answer when I thought about the question was, the mismatch between when you have to get a premium and when you have to pay a claim. Sometimes you can't. The time horizon is not such that you can put money to work in the market for a year or two if you're already paying out claims, and so you've got to keep it liquid. But I think maybe the better answer of how Lou Simpson did that at GEICO and how Warren has done this is that the capital ratios at Berkshire were just so phenomenal that the insurance regulators didn't require them to keep 90% plus in liquid overnight paper to pay claims. The other thing too, and Berkshire being different than GEICO, particularly National Indemnity and Sheet, is the long tail super cap policies that don't have to be paid out for 3, 4, 5, 6, 7 years. So in that situation, obviously a premium income that doesn't have to be paid out for at least 5 years or more, that would be ideal for the stock market. So then the question then becomes, those that are in that business, their capital ratios are strong enough to allow them to invest for 5 years. Why aren't there more, Warren Buffett type investors and insurance companies? And that goes to, I think it was chapter 6 in the new book. It was the Charlie Munger quote that, if we're so right, why are so many intimate places so wrong? Why aren't other people doing that? And that's a phenomenally great question, because it's very clear, not only the Berkshire approach, Warren's approach, Charlie's approach, it's now called high active share investing. We called it focus investing when we wrote the Warren Buffett portfolio in 98. But now the academicians got a hold of it in the early 2000s. I think it was Martin Kremers and Pettigiusto at Yale University that quantified what focus investing was, now called high active share. And high active share investing is a predictor of future performance, in that you have to be different than the market to generate returns different from the market. then they subsequently went on and discovered of the high active share portfolios, it was the low turnover portfolios that were the very best high active share. So you have the method, you have the architecture, if you will. High active share, low turnover portfolios have the highest probability of generating returns in excess of the market. Then how come they're not more high active share, low turnover portfolio managers? And this is a big puzzle. We tried to answer it the best we could in the book, in that there just weren't that many that were raised under the principles of what Warren was doing when modern portfolio theory, which was invented in the 1950s with Markowitz and refined by Sharpe in the 60s. You can go to Eugene Palmer in the 70s and 80s. Modern portfolio theory was really just academic type thinking until the 73, 74 bear market. And then when everybody blew up the bear market, value investing actually wasn't being taught then at Columbia. There was a void, and people were really decimated. People who had retirement savings were wondering if they could retire. The market had been down 50%. And people were looking at each other going, what do we do? What do we do? And these academicians from the ivory towers raised their hand and said, hey, I've got an idea. What about low price volatility? Lots of diversification. So if anything goes wrong, you don't have all your eggs in one basket. And we'll do quarterly reporting, and that will show you exactly what your portfolio is worth, every 3 months. And that took over the money management business in the early 1980s at the beginning of the big bull market. And we created, the standard of investment management off the principles of modern portfolio theory. And that became the edifice, the Leviathan, if you will. And from that, we just didn't germinate a lot of Warren Buffetts. They're just, we know a few of them, they're well recognized. We know their firms, but as a percent of the total money managed and money management and the total number of people, the percents are so small, it's baffling why more have not reproduced and had a lot more. It's a wonderful question, and even Charlie was mystified by it. But I think, it's kind of quixotic to kind of fight the windmills of modern portfolio theory to say, you guys are crazy. This doesn't work and you guys are losing money. That's why people are indexing and going to alternatives, because you can't beat the market. I think S&P just finally came out with the new data. 93% of all active managers can't outperform over 5 years. Yep, but they still stay in business. I don't know how that. You don't outperform for 5 years, but you still stay in business. And they should go away, right? They should shut their doors and go away, but they somehow or another find ways to stay in business. But the more perplexing part is why we haven't replicated more Warren Buffett's and Charlie Munger's. The answer may be, Kyle, you and I have talked about that, is the temperament required to run these high active share, low turnover portfolio is a temperament requirement that is beyond the ability of most people to have patience, to suffer through periods of underperformance. When we looked at the high active share managers in the Warren Buffett Way, and this goes back to Sequoia Fund and Lou Simpson and Charlie, you can go back to John Maynard Keynes, who ran the Chess Fund, phenomenal long-term track records, but their batting average was about 50%. They outperformed month to month, quarter to quarter, year to year, only 50% of the time. And the other 50% of the time, they underperformed. And of course, when I say this, people say, well, how did you beat the market for 5 or 10 years if you underperform half the time? And the answer is, as you well know, Kyle, it's the difference between frequency and magnitude. It's not how many times you beat the market. Less how many times you don't beat the market. It's how much money you make when you beat the market, less how much money you give back. And so when you make money as a concentrated big bet portfolio, you make a lot of money. And if your valuations are good, when the market is against you, you're just not giving it back wholesale. And so the net difference between those is your excess return. And that seems to be academically proven. And we know that. But then the psychology of being wrong half the time on a month-to-month, quarter-to-quarter basis, as we know from Danny Kahneman and Amos Tversky's prospect theory, that unit of not beating the market for the quarter, the month is twice as painful as the unit the next month or quarter when you do beat the market. And so you're in a constant psychological impaired position running high active share portfolios. The rational, logical people understand it and move through it. Those that don't really have the rationality to their back get whipsawed by it. So it's a combination of a lot of things, but the proof is in the pudding. It still stupefies me that there are not a ton more Warren Buffett-like money managers out there.
It's funny too that you mention obviously those tremendous track records of people that I love following, especially John Maynard Keynes, who's very underrated. But it's funny also when you also add the psychological impact of managing other people's money to the fact that when you do have a concentrated portfolio, your long-term results are probably gonna be really good, but you also have to deal with the personality or the personal aspect of having people that you have to talk to being like, hey, what happened? What happened this year? What happened this quarter? Yeah, and that alone is, I'm sure, very, very painful.
Yeah, I worked with Bill Miller for 14 years. So, so if you kind of think about the writings of Warren Buffett, it's kind of like I did my PhD dissertation, kind of went to grad school and wrote a PhD dissertation. The other half of my experience, so was actually the practicalities, actually being in the hospital with Bill Miller working on patients, right? And here's a guy that had a phenomenal track record. And, he was, when I joined him, I think he had beaten the market 7 years in a row. And as kind of a newcomer on the team, I acted as a portfolio specialist. So I was running a growth portfolio as a retail fund, but Bill wouldn't let me run it institutionally until I had a 5-year track record at Legg Mason. So most of the time I spent, I was managing the growth mutual fund, but in the same time I was out on the road, helping Bill with his institutional accounts. And these, institutional accounts, consultants, very smart people, go to grad school, stuff like that. And so you got a guy that obviously knows what he's doing. He's brilliant, writes brilliantly, has performed brilliantly. And it seemed like, if he had a bad month, bad quarter, you're sitting there trying to explain, why is Bill wrong? Bill's not wrong. The market, as we talked before we teed this up, the market gravitates for a lot of different reasons other than, arbitraging price and value. There are a lot of reasons why stock prices move. But you're right, even at the institutional level where you think they are above the individual irrationality level, they still had the same pressure points. We're underperforming, we're behind the benchmark. And I'm like, you guys are just, of course I couldn't say that, but you just kind of look at them and go, you really are in charge of these multi-billion-dollar plans. And these are the decisions you're making. You just kind of shake your head and go, God, no wonder this is a mess. It is a mess.
So I enjoyed how you mentioned more about the history of Buffett's investing philosophy in this edition, as we kind of spoke before. So you wrote, quote, all of these separate components, your view of the market, your methods, and your temperament as an investor reflect the totality of your philosophy of investing, unquote. So we could easily probably spend an entire conversation discussing this one quote, but we won't. However, I do want to dig into one point, which is your view of the market. So Buffett learned a lot about this view of the market from Benjamin Graham in his book, The Intelligent Investor. So this approach is obviously much different with that is taught in higher education, which you kind of just pointed out. But I'm also interested in learning just a little bit more about what differentiates Warren Buffett versus the majority of people in finance.
Yeah, I think where I think Warren had the benefit that he was able to lever into this long-term track record is that he did two things. One is that it resonated with him when Ben said stocks are businesses and we're trying to buy businesses at cheap prices. Ben didn't say we're trying to buy great businesses at cheap prices. We're trying to buy this business at a cheap price. And as Warren said, as soon as I figured out that what Ben was saying is we're going to buy $1 worth of value, 50 cents, I got it. And I ran with it. And so he, early on at 19 years old, he said stocks, are just businesses. And I think it was Graham that said in The Intelligent Investor that the moment you buy a common stock, you have a choice, instantaneous choice. You can either decide to be an owner of that company, which legally you are now an owner of that company, or you just hold a piece of paper that you can trade moment to moment, week to week, month to month, and you can decide which one you're going to be. Well, Warren, chose the formula, which is, I own a business and, I'm going to hang on to it for a while. And I think that was hugely important. Then let's layer on top of that the actual experience when he put Berkshire Hathaway together of both having privately owned businesses. Go back in Berkshire Hathaway, you can then talk about the insurance companies and go to Nebraska Furniture Mart and See's Candies and Buffalo Evening News and on and on and on and on. He owned these companies. They didn't have common stock prices. He owned the businesses. And he intellectually thought about those businesses exactly the same way he thought about owning Washington Post or Cap Cities or GEICO or, go on down the list, Coca-Cola. For him, the mindset, the telescope of how he thought about it was identical. So he didn't say, I own these businesses over here, Nebraska Furniture Mart and See's Candy, but I also own Coca-Cola. So I'm going to analyze Coca-Cola differently than I do Nebraska Furniture Mart and See's Candies. So I think there's a quote that you and I've talked about before that Warren thinks that stocks are really an abstraction. Common stocks in and of themselves are really abstractions. He doesn't think in terms of common stocks, sectors, correlations, diversification. He doesn't think about stock market theories. He doesn't think about macroeconomic concepts. He just thinks about the business. Now compare and contrast that with, an institutional money manager. All they do is think about stocks, common stocks. They think about the beta, the variability and the information ratio and all this nonsense, right? And they're worried about what sectors they're in, what they're not in, the correlations, They've got all these theories about the stock market, which tells them what they should overweight and underweight. And God, they're all into macroeconomic concepts, predicting what the economy is going to do. Is going to tell you what the stock market is going to do, which tells you what sectors to be in, and Warren does zero of that. Zero. And so at the end of the day, I think his competitive advantage is that he does none of that. He has purposely divorced himself from everything else that consumes 99% of the people that invest in the market. It's his purposeful detachment from the stock market that has allowed him to behave so rationally over these last 50, 60 years. And that behavior is the source of his excess returns. And so when you think about it in those terms, getting into that mindset early and then having it perpetuated by both owning private companies simultaneously with public companies and decided to treating them exactly the same, that's the golden sauce. That's the golden egg right there.
So moving on to Warren's father, obviously you mentioned him as being a massive influence on him. So Howard said one of his biggest lessons, that Warren learned from his father was that nothing can bring you peace but the triumph of principles, which I think is a wonderful little quote there. And as we look at Warren's evolution as an investor, I would say this has definitely held true, but he has obviously had this significant evolution in his investing strategy from when he was younger and he was a Grahamite, moving from cigar butts to, moving more towards the quality end of the spectrum. So I'm just interested in learning your opinions a little bit more about how he made this transition while also staying true to his overguiding principles.
Well, let's start. There's two pieces to that if we unpack it. The first part is, his dad, Howard Homan Buffett, as I said, was a libertarian. He was both a teacher too. I mean, he taught in Sunday school. He volunteered for the school board. He was a teacher by being a congressman, but he was also deeply influenced by the philosophy of Ralph Waldo Emerson. He was an Emersonian. And if you go back and look at Emersonian philosophy, probably the most celebrated essay was self-reliance. So in the book, we kind of walk through self-reliance step by step. And when you do that, you actually see Warren Buffett every step of the way. Independent thinking, right? It's not what the community thinks, it's what you think, your principles, not what, it's what he was talking about the community. Warren said it's at the stock market, right? It's your principles, not the stock market's principles. People are going to tell you what you think you should do. Don't listen to them. Do what you think you should do. That was all powered by his dad, Howard Homan Buffett. And I owe a nod to Roger Lowenstein, who wrote a great book, Buffett Making American Capitalists, that came out in the spring after Warren Buffett Way came out in 94 and was also a New York Times bestseller. Great book. Roger's a wonderful writer. And it was Roger that basically had helped me make that connection because he talked about it was the sweet philosophy of Emerson that led to Warren's, principles of self-reliance, if you will, right? Which is the cornerstone of self-confidence, which is what you need to have in the market to operate independent of what the market's doing. So we spent a lot of time going through all of that. And you can see that had you been 10, 11, 12, 13, 14 years old, and every night, remember in the 1940s, there are no video games, there's no cable TV. There wasn't even TV, it was radio, occasional Saturday, movie if you got lucky, but the rest of the time you're reading. And when you got to the table, you talked. And so here's his dad, wonderful teacher, just pounding his son on Emersonian philosophy and libertarianism. And it's the self. The self is what governs you, not the community. And so that was inbred in him, really, really at a young age. And I think that was his backbone that allowed him to make these moves. And then, as you kind of go, the aggravation of owning Berkshire Hathaway, and then Dempster Hill Manufacturing, and the department stores that were all bought under the principles of Ben Graham were cheap businesses, but they were bad economic returning businesses. And it was Charlie, as Warren testified in the annual report this year, whose insistence that they buy See's candies, which violated every single principle that Ben Graham had ever said. By the Graham principles, Warren should have never bought See's candy. But, Charlie probably browbeat him down, and he paid 3 times book value. And it became, I argued in the book, probably became one of the most, dollar for dollar, the most profitable investment that he'd ever made. The light bulb then goes on, right? It's like, wait a minute, I bought something here that didn't comport to my mentor's process of methods of buying stocks. And this thing was a home run. And he began to think about, as he looked at his companies, it's the cash that comes out. And, what do you do with that cash? And the cash that was coming out of Berkshire Hathaway and Dexter Hill Manufacturing and the retail store, there was no cash coming out. They were broke every year. So there was no money to take out of those bad businesses to go buy other businesses, where See's was gushing cash. And with that money, he could go buy other businesses that were gushing cash that could allow him to go buy other businesses gushing cash. So that tangible, real experience of owning a company that did that. Then he looked at Coke and he said, Jesus Christ, this thing is gushing cash. Roberto Gazzetta had showed up, changed the economics of the business after Paul Austin almost drove it into the ground. And he was buying back stock and it was raising the dividend. Cash just kept flooding out. And so, it's been argued, and I think it's true, that the lessons he learned from See's Candy got into Coca-Cola and American Express. And there's some that argue that same cash gushing phenomena at Apple is what turned him on. Remember, in the last 10 years, Apple's bought back half of its stock. It's reduced its share count by 50% on the way to going from $600 billion to $3 trillion. And you bought back half your stock. That's a lot of cash coming out of there. So that goes in my mind all the way back to See's Candies.
So I want to turn to some of Buffett's learnings on intrinsic value as he evolved. So, when he was a pure Grahamite, intrinsic value is essentially just a benchmark to reach that would trigger the sale of an asset. But as Buffett began scaling up capital, he realized that holding businesses where intrinsic value would continue growing were a better option for him than just, finding something that wouldn't grow. So it's funny because his success with the Graham approach kind of necessitated him moving on from it, as it was just no longer an effective strategy as his capital grew as well. A lot of these opportunities he was looking at were small, right? And just it wouldn't work with a lot of capital. So I'm just interested in knowing what were some of Buffett's other well-known aspects of Graham that maybe he had to ditch as he began scaling up his capital.
Well, in fairness, we did say in the book, Graham gave him he gave him a temperamental foundation, which we could talk about, but also a methodological foundation, which was absent. Buffett actually was a chartist. He was doing technicals and stuff like that until he read The Intelligent Investor. And finally, that was the epiphany. And he applied it to the Buffett partnership from 56 to 69 with great success, which, gave him financial independence, financial security for his family, and then obviously gave him the resources that he eventually was able to take control of Berkshire Hathaway. So to say that Graham wasn't a big, huge part of his success, it played a very big role for a period of time. you rightly point out, Kyle, that as the asset base got higher and bigger, moving money around a lot, because in the Graham approach, once you got to fair value, you had to sell and move on. Fair value being you were trading at book value or you were trading near the market multiple. And having bought it at a discount to the market multiple or a discount to book value, you arved that until it got to Graham's definition of fair value, and then you had to move on. You had to sell it and buy something else. Well, as you're working with bigger and bigger sums of money, this kind of not high trading, but the often need to buy and sell things was impractical for him at Berkshire Hathaway. And, he finally learned that buying and holding a mediocre company over time gives you mediocre returns. And so if I can't buy and sell them, as I did in my partnership years, and I got to buy and hold, See's Candy taught him, buy and hold good stuff. And of course, National Indemnity was teaching that at the same time. Buy and hold good things that generate a lot of cash, and you'll be in pretty good shape. So then he was definitely moved on from Buffett's methods of picking stocks. But the two parts that are still today, ever present, chapters 8, chapters 20 in The Intelligent Investor. One is the margin of safety. Buy something for less than it's worth. Calculate its intrinsic value. Buy it at a discount. He goes, today, those are still the right three words, margin of safety. And then in chapter 20, it was, the temperament of the market, distancing yourself, purposeful detachment from the market. The market is not your boss. It is there to serve you, not guide you. And those two parts are still the cornerstone of his philosophy. And those are Graham principles. So you could say Graham still carries a very big arc of influence on Warren, but it's now been reduced to buy value at a discount, margin of safety, which was there in 1934, and how to think about the stock market from a temperamental standpoint, which was there in 1949 in The Intelligent Investor. So it carries a lot of weight. Then the question then becomes, what happened after that? You and I have talked about the influence of Phil Fisher. Fisher was not methodologically about the quant side as Ben Graham was. He was looking for great companies run by great managers. So he was more on the fundamental side, things that were not easily quantifiable. But if you bought a great company run by a great manager and held on to it for a long period of time, usually something good happened to you. The compounding and holding of great businesses was Phil Fisher's reward. And so Warren slowly was merging these things together. The quote that I think is misunderstood is in the 1960s, he said, I'm 85% Graham and 15% Fisher. And that's a quote that has been used often by times, but you got to put it in context. That was before he bought See's Candy. So, if he would have said, what's that quote after he bought See's Candy, it might have been 50-50. Today, it might be 50-50, which is business and management matter a lot. The kind of business that you're in, future prospects of the business that you're in, is it favorable? Do they earn above the cost of capital? Do they increase shareholder value? Those aspects of the business that Graham never talked about are important, just as it's important that management rationally allocate the resources of the company back to the company itself, as opposed to themselves or making stupid acquisitions for the sake of enlarging the corporate edifice. So management and the type of business started to rank very, very high in the compounding of his wealth. So I would argue today, if he was said, I think it's more 50-50 Graham and 50-50 Fisher. But even that, then where do you put Charlie? And I'd probably put Charlie in the Phil Fisher camp, who was the actual proponent, the actual practicality of the Phil Fisher philosophy. Charlie was probably more akin to Phil Fisher, and the types of stocks that he bought were more like Phil Fisher stocks. Charlie didn't have a lot of Ben Graham stocks. He didn't have bad businesses that were cheap. He had pretty decent companies, and those that he held compounded at a high rate. So you got to put Charlie in that Phil Fisher bucket. And then it tips maybe more than 50-50 when you combine Charlie and Phil Fisher together. That's a pretty big bucket. It's a big bucket.
Yeah, those are excellent points. So you wrote a fascinating point that you kind of actually touched on a little bit earlier about how Buffett looks as stocks as an abstraction. But I just want to say this quote. So, quote, for Buffett, stocks are an abstraction. He doesn't think in terms of market theories, macroeconomic concepts, or sector trends. He makes investment decisions based only on how a business operates. So you kind of did a really good job of talking about that abstraction and why he thinks of it. But I want to actually just invert the question and ask you if you think there's any potential downsides to looking at a stock the way he does as an abstraction. I'm just interested in knowing your opinion on that.
Only in the short term, because there's still enough people that are still looking at stocks as these abstractions of beta, of information ratio, of correlations and stuff like that. If the game is short term, and there are people that play the short term game, it's embedded in modern portfolio theory. It's practiced, largely in the standard approach to investment management, that people want smooth returns, non-correlative returns, conservative returns, but they want consistent returns. All those things are important. You would say, market theories and macroeconomic concepts. It stupefies me that people still feel the need to embrace, or at least are attracted to these concepts where we already know, scientifically proven, that there is no model, no individual, no model that can predict complex adaptive systems. Go to the Santa Fe Institute. Bill Miller introduced me to that in the 1990s. There are Nobel Prize winners out there. They will tell you there is no science on this planet Earth that can predict the behavior of a complex adaptive system 3 months out, 6 months out, 9 months out, 12 months out, much less, you might argue, overnight.
Hey guys, it's Clay Fink here, host of We Study Billionaires. Today, I wanted to tell you about our show sponsor, Vacasa. The dream of owning a vacation home can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. With Vacasa, they make that dream into a reality. As a full-service vacation home management company with vacation homes in key destinations across the US, they know how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a data-driven booking platform, and around-the-clock support, homeowners earn on average 20% more revenue from their vacation homes. Vacasa makes vacation home ownership easy. If you're looking to make more from your vacation homes by doing less, partner with Vacasa at vacasa.com. That's vacasa.com.
Still, people are obsessed with talking about it, thinking about it, believing in it. And I, once again, one of the things like, why is that psychological need? I think the idea that you are willing to say, I don't know what's going to happen tomorrow, but it's not important to my investment process because I have a good business, right? I don't know if the economy is going to grow fast or slow. I don't know if the stock market is going to go up or down. I don't know what the geopolitical outcome is in the Middle East or in Ukraine. Nobody knows. We don't know. And absent that, you go, well, what are you going to do in the stock market? Buffett would say, well, whatever happens, I want a good business. So if the economy is accelerating, what do you want? I want a good business. If the economy is going into recession, what do you want? I want a good business. If inflation is going up, what do you want? I want a good, I don't want a bad business. I want a good business. If we get into a geopolitical war, what do you want? I want a good business. Almost in every outcome that you come up with that can be bad, what is the best solution? Own a good business. The only time someone says, I really want to own a bad business is that if you think you can sell it real quick. I buy it now and I sell it pretty quick. But this psychological need that I can't operate without having some grasp, even though it's, obviously fleeting, that what's going to happen tomorrow, next week, next month. Just people spend 80%, 90% of their time on these things they can't predict and on things that have nothing to do with business value. Warren Buffett spends 95, 99% of his time on nothing but business. Just think about that. He does nothing but think about businesses. And hardly ever about the stock market, only glancing at it every once in a while to see if it's done something foolish that allows him to take advantage of a misprice in the market. And we, the pejorative we, spend 90 some of our percent. What are we doing? Pontificating about the market, pontificating about the economy, pontificating about geopolitics, the presidential politics, who's going to win, who cares? Doesn't matter. whatever the outcome, what do I want? I want a good business. That simplifies your role pretty quick. But as you well know in this business, out of 10 phone calls you get, 9 of them are going to ask you those questions. So you're not going to have a long career if you don't at least contribute something to it, even though I say to them, I have no idea, but you might think about it this way or that way. And, well, what are you doing, Robert? I go, I'm buying good businesses. That's all I'm trying to do, just buy good businesses. Seems pretty simple to me.
So before we go to the next question, you've actually mentioned something, the information ratio, twice. So just for listeners who might not know what that is, do you mind just quickly explaining what it is?
Yeah, it's a stupid term that came out of modern portfolio theory that basically looks at the volatility, the return of the stock to the actual return of the stock. And if the actual return of the stock is higher than the volatility, then you have an excess return that shows up in the information ratio. The higher the information ratio that you have, it is perceived that you've made a smart calculation that rewarded you beyond the volatility. Efficient market hypothesis would say that, and there's still people that believe in that nonsense, but basically say, if you bought a high beta stock and you had a high return, it was only because you bought a high beta stock. Oh, okay. But information ratio says you bought a high beta stock, but you actually got a return that was even higher than what the volatility would imply that you got from the return. There are people that actually pay a lot of attention to that. Warren doesn't. I don't even think Warren knows how to define it.
Yeah, and we'll actually be covering that question on that in a little bit. So, but yeah, let's get back to it. So you made a really good point about Buffett and his evolution towards Philip Fisher. So obviously, you've already talked about how a lot of moving on to Philip Fisher was kind of moving on to the qualitative end of investing and relying less so on the quantitative ends. But if you had to really distill Warren's biggest takeaway from Philip Fisher, what do you think that one thing would have been?
Well, actually, the famous term circular competence actually originated from Phil Fisher. And that was in his 16 points. He had 16, if you go to the book, Common Stocks and Uncommon Profits, he has a list of points. That's his checklist. And one of them is just stick in your circle of competence and, know what you know and know what you don't know and stick with what you know. If you don't know something, you're not going to do a good job analyzing it. And when the price deviates because you don't know a lot about it, you'll never know if you're right or wrong. And then the game's up, the gig's up. If you've lost the self-confidence, am I right, am I wrong? The gig's up. What was the famous quote from Warren Buffett? If you're a poker game for 20 minutes, and you don't know who the patsy is, you're the patsy, right? Well, the market's the patsy. In Warren's life, the market's the patsy. I know who the patsy is. The patsy is the market. It's going to make some dumb bets, right? It's a sucker on the other side of the poker table, right? I'm just waiting for them to make a wrong bet with the cards that they have in their hand. And I've got a pretty good idea what the cards are, and they're going to make a stupid bet. And then I'm going to bet contrary to that. So I think, circle of competence is real good. He did talk about management and, channeling the rewards of management back to the company. Phil Fisher was big about compounding. He didn't need the dividends, put it back in the company. That's Warren, don't pay it out in the dividend. If I'm earning above the cost of capital, just say your opportunity cost of capital is 10%, which is what Charlie believed the cost of capital was, not the capital asset pricing model definition of it, but just your opportunity cost of capital. If you're lending money to the stock market, it's perceived that you should generate at least a 10% rate of return, historically speaking. So if I'm lending money at 10%, I should expect back at least 10%, if not more. If I'm not getting back 10% or more, then what's the purpose of doing this? So if your cost of capital is 10 and your company earns 15 or 20, or like Apple earns 100, what do you want them to do? Keep the money, keep it all. Don't pay a dividend. That's the Amazon story. I don't know, we're on the day here that Andy Jassy wrote the annual report on Amazon. It's just a wonderful annual report. But if you look at the operating cash flow of Amazon before it takes it to the bottom line to pay corporate taxes or give out a dividend, they put it back into the company, right? But that operating cash flow before they reinvest it in the company is probably a 3 or 4% cash flow yield. That's pretty good, But then they say, well, why do I want to pay tax on that when we're growing double digits, earning above the cost of capital, Put it back in AWS, put it back in retailing, put it back in advertising, put it back in Amazon Prime. So Amazon has been a high PE stock since 1999, and it's, a $2 trillion business. So much for high PE, low PE investing. It has nothing to do with the growth of intrinsic value. It has every bit to do, did you earn above the cost of capital? So I've deviated a little bit from your original question, but once again, what are we talking about? Businesses. We're talking about the economic returns of businesses. What are we not talking about? PEs. We're not talking about sectors. We're not talking about, is the economy going up or down? What's going on with interest rates? Oh, it's inflation's up. The Fed's not going to cut interest rates. Who cares? Just buy a good business. That's all we have to do.
So we've obviously spent a lot of time thrashing portfolio management theory and efficient market hypothesis. But you know what? We're going to keep going with that on that theme. So you pointed out in your book that Harry Markowitz developed his theory at the very young age of only 25. And he assumed that the unpleasantness of price volatility was the risk that investors should avoid, which is an interesting conclusion. But and I know that you spoke a little bit about how, security analysis was already out at this time, and clearly just, obviously he ignored it, or I don't know. But I'm just kind of trying to figure out why he completely missed the point about the underlying value of a business. And I'm just kind of interested in knowing your thoughts on why he came to the conclusion he did.
I'm so glad that you brought this up. This is a big topic that I'm going to be talking about at Berkshire at a couple of the conferences. So when Charlie said, we're so right, why are so many eminent places not copying us? It goes back to why is modern portfolio theory the dominant standard management practice? And so we went back to, you go to first movers. Right? So how did this whole thing start? So here you have this, little kid, 22, 23 years old, right? A well-mannered boy, played the violin, great grades. David Hume, the Scottish philosopher, was his favorite philosopher. Goes to the University of Chicago, decides he wants to stick around, spent some time at the Coles Commission, that came over from Yale, had done a lot of work on forecasting markets, got intrigued about the stock market, decides he wants to get his PhD in economics, and decides one day that he's going to write his PhD on the stock market. And kind of gets, because, it's more of an economics thing, gets into, risk and return. So I went back to the original paper. For a PhD dissertation, I think it's 14 pages. Most of it's graphs and tables. There was only 3 citations, one of them, which was John Burr Williams, which we'll talk about in a second. But he writes in there, so he kind of says, just like in the first sentence, we consider the rule that the investor does or should consider expected return as a desirable thing, right? Your return is desirable. I get that. And then he writes, and the variance of the return as an undesirable thing. Okay, so he's saying variance, price volatility is undesirable. I let him slide on that. Says they both have sound points, blah, blah, blah. But then he says the term yield and risk frequently appear in financial writings, but are not always used in precision. Even Graham said, sometimes investing is not precisely defined. But then he says this is where the slope gets slippery. He says, if the term yield, which is expected return, was replaced with expected return, and risk, now he's defining risk right here by the variance of returns, little change in the apparent meaning would result. Okay, so right there, here's this 25-year-old boy who's never invested in the stock market, never owned a company, never been in business, anything, and he's all of a sudden going to define risk as variance, volatility. Okay. If I'm writing a PhD dissertation and I have a dissertation committee, much less a dissertation thesis advisor, and I make a statement like that, it has to be defended. Better yet, you have to look at the counterfactual. What do other people say about risk? Is there somebody else that has a different definition about risk? And so to your point, this was 1952 that the paper was published. So go back. Well, in 1934, Security Analysis published. And right there, margin of safety is defined as risk. If you're operating with a margin of safety, that's low risk. If you're operating above intrinsic value, that's bad. Then go to 1938, Theory of Investment Value is published. He cites the book in defense of his thesis. If you go to John Burr Williams, he says this: investment value, defined as the present value of future dividends and future coupons and principal, is of practical importance to every investor because it is the critical value above which you cannot go in buying and holding without added risk. John Burr Williams saying it's if you buy something above its intrinsic value, That is risk. Okay, there's a different opinion about risk, right? And then 1940, Security Analysis, second edition. 1949, The Intelligent Investor. Benjamin Graham writes it all down. Difference between short-term quotational loss, permanent capital loss, margin of safety. Then 1951, the year before his thesis is published, the third edition of Security Analysis. Columbia University and Security Analysis owned the finance academia. Here he is at University of Chicago, Marshall Ketchum, who was the dean of the economics department and his PhD advisor, and on his PhD dissertation, had a brand new academic journal that had just been launched called the Journal of Finance. It was only just a couple of years old, kind of fledgling, didn't know what to do with it. Markowitz's paper ends up in the Journal of Finance, and no one on the dissertation committee ever said, there's some other people that have a different definition of risk. Never mentioned. So nothing happens. He goes off and works for the Rand Corporation in the 1950s. He's doing, and then, Bill Sharp shows up and he's looking for a thesis of his people. He was at UCLA and they said, track down Markowitz. He goes to see Markowitz. Instead of doing all the non-correlative, strategies or doing the tabulations of non-correlations, he says, why don't we just find one thing to measure everything against? What has the most influence on the market is beta. It's the market price itself. You give it a name called beta. If your price bounced higher than the market, you had a beta greater than 1.0. If it bounced less than the market. So at any portfolio, the weighted average of its betas in a portfolio, if it was above 1.0, you were riskier than the market. And if it was less than 1.0, you were less risky than the market. Okay, that's 1963. Nobody gave a damn. Nobody on Wall Street paid attention to it. Nobody cared. It was never mentioned much of anything ever again until the 73, 74 bear market. And as we talked about earlier, you wiped out half of people's money because people were into the Nifty 50 stocks, the go-go stocks. They weren't doing valuation work. It was all momentum trades. It was Jerry Zai at the Manhattan Fund. It was the go-go years. Great book by John Brooks, one of Warren's favorite books, talks about it. The important part was that value investing had gone away at Columbia University. So Graham retires in 1956. There was a guy named Roger Murray that took over his spring seminar class. David Dodd retired in 61, 62. Roger Murray then taught the fall investment management class that David Dodd taught, and then the spring class. And he was the guy. He was the guy from the 1950s, and he retired in 1977. And the attendance of the value investing classes continued to go down through the late 60s into the early 70s because everybody was in the Nifty 50. Those weren't low PE, low price to book value stocks. So there wasn't a lot of people attending value investing classes. In 1977, Roger Murray retired. That was the end of the security analysis course. There was no there was no value investing being taught at Columbia University. So, the ashes of the 73, 74 bear market, were there. Portfolios are, in rubble. Everything is down. But as what typically happens, time passes and people begin to return to the stock market, and they were returning. And as we got to the early 80s, interest rates were being cut. That was the beginning of the big bull market, and firms were being organized again. People were starting investment management firms, and they kept saying, well, what are we going to do? How should we do this? And a couple of these guys that were disciples of Markowitz and Sharp, and they were still in business, teaching and stuff like that, said, hey, that 73, 74, yeah, what if we did non-correlation and wide diversification and stay away from high beta stocks, and we do conservative returns, and we think price volatility is the evil that must be, slain. What do you think about that as a money management practice? And they went, yeah, this'll sell. This is what we got to do. We've got something for you that's going to prevent what happened in 73 and 74. And so it took off. Now, Buffett shows up back at Columbia in 1984 for the 50th anniversary of security analysis, and the very famous speech that he gave, the super investor of Graham and Dodd's bill, kind of lit a spark back into Columbia. David Dodd's family endowed professorship. A guy named Robert Helbrom got involved, and they started to resuscitate value investing. But it wasn't until 1991. It was Bruce Greenwald, 1991, that became a professor. And he himself then was probably the most responsible for rejuvenating security analysis. Of course, came back. Value investing became a harbinger of Columbia, but it was too late. By then, you were 10 years into the bull market, and money modern portfolio theory was ubiquitous everywhere. And so I think that period between 77 and 82, 83, almost 7 years, where the value investors were absent and weren't there to offer a counter argument, allowed modern portfolio theory to get a lead. It took off and, created a Leviathan that is still the dominant theory today. And that's kind of how we think about it. So then the question is, well, if in fact Berkshire Hathaway is the rational way in which to do it, and all this other stuff doesn't meet markets over the time, why don't we change? And then you go to Thomas Kuhn's theories of scientific revolution, talk about paradigm shifts. Go ahead and tell a couple of professors that have their PhD in modern portfolio theory it's a bunch of bunk and see if they agree with you. They're out of a job. They don't have a class to teach. Go tell guys that have billions of dollars in modern portfolio theory. You know what? That money management practice is making you millions of dollars a year that gets you all the luxuries and everything that you want. You need to shut that down. It doesn't make any sense anymore. Well, no, they're not going to do that. They're going to defend that till hell freezes over. So we're now, we have these two paradigms, right? And that's kind of where we are now. And so one of Charlie's favorite quotes, I think, was Max Planck, the German physicist, said, science advances one funeral at a time. You just have to wait for these guys to die off, and hopefully going to be repopulated with, the Berkshirists. They're going to rise up. I don't think we have to wait that long. And I have some ideas, maybe how we can try to light a spark under it. But it gave me a great deal of satisfaction, personal satisfaction, to understand how to answer Charlie's question, which is what we do makes a lot of sense, makes a lot of money. How come it's not taught? I think I got to the bottom of why that happened.
I wanted to discuss now Buffett's points on risk and how it obviously differs a lot from the portfolio management theory. So Warren's view on risk is the possibility of injury or harm to the intrinsic value of the business. It has nothing to do with the fluctuations in stock prices that are taught in portfolio theory. So you wrote, quote, in Buffett's view, harm or injury comes from misjudging the primary factors that determine the future profits of your business. 1, the certainty with which the long-term economic characteristics of the business can be evaluated. 2, the certainty with which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flows. 3, the certainty with which management can be counted on to channel the rewards from the business to the shareholders rather than to itself. And 4, the purchase price of the business, unquote. So what really stood out to me on this incredible list is the word certainty. Obviously, it's mentioned in 3 out of 4 of the points. So I'm interested in knowing just kind of more, this is more of a question to you than what Buffett would say, but you can obviously inject anything that you think Buffett would say. But obviously, the market loves certainty. But, the problem with certainty is you pay for it. So I'm kind of interested in knowing, how can investors best balance, being certain about investment and coming up with a purchase price that makes sense?
Well, I mean, it's long been said that Warren's, investment approach is to buy certainties at a discount. Your point, or at least your observation, would be oftentimes certainties are priced at a premium. And that's probably true, but not always true. As Warren says, the market is frequently efficient, not always efficient. And there are times when the market's got it wrong. So go back to Coca-Cola. Coca-Cola was trading at a high price earnings multiple was above the market, high price to book value, below average dividend yield by every metric you can think about it. In 1988, Coca-Cola was no screaming bargain whatsoever. Warren invested $1 billion, a third of his portfolio, in what he believed was a certainty of all those things that you just said. Good business, good long-term outlook, good management. I'm going to allocate the capital rationally, and I got it at a good price. In 10 years, that billion went to 10 billion. $1 billion in the S&P went to 3 billion. Did he buy a certainty at a discount? Yes. Was it perceived to be above its intrinsic value? Yes. But the way in which you think about value sometimes is different than how the market thinks about value. So we go back to the dividend discount model. It's a different way to think about value than price earnings ratios. So if you, Warren, kind of continued to elaborate on this. So if we kind of think about three certainties that we're trying to get right, which is what are the economics of the business and the persistence of the company to continue to generate attractive economic returns. That's one certainty bucket I'm trying to figure out. The second certainty is who are the people running the company? Are they going to rationally allocate capital? And in doing so, will they do it to enrich shareholders, not themselves? And third is purchase price. He goes, of all those three things, I rarely have gotten the purchase price wrong, and I've rarely gotten management wrong. The mistakes I've made is miscalculating the persistence of the company to generate high returns of capital over time. That which was generating attractive returns just didn't do it for as long as possible. And so that's why he spent, as you know, Kyle, he spent so much time on moats. Moats are the ability of, if a company has a big moat, which is nothing more than it has the ability, a competitive advantage period that's going to last for a long period of time. People that have a competitive advantage period that lasts a long time, in Warren's metaphor, have big moats that people can't attack the castle and take their business away. So the mistakes that he has made, the biggest mistakes that he has made is that a company that he thought had a moat and a long competitive advantage period did not. Now you could argue that was probably that you didn't buy something as cheap as you thought it you did. It wasn't as worth as much as you thought it was. And there's some rationale to that. But really, it gets down to when you're a long-term investor and you're compounding something. You own something that generates good returns on capital that can be reinvested back in the company to compound. It's your thinking on who are the competitors, how quickly are they coming over the moat, how quickly are they going to take your business away, or how quickly do your customers decide they want something else? That's the problem. And so much of the thinking today for, I think, value investors that are compounding money is basically trying to answer that question, whether it's MasterCard or Visa or credit card processors or, and in my case, we own a lot of technology. So it's how long does Amazon keep doing this, or Google, the cloud service providers, how long can they keep doing this? When is somebody going to come over, attack the castle and do what they do cheaper and better than what they're doing? So we spent a lot of time thinking about that competitive threat, because that's the one certainty that Warren has gotten wrong, which could be then argued that that's been the biggest risk in his portfolio, is misjudging the certainty of a company to do that for a long period of time. Does that make sense?
Yes, that makes perfect sense. And that actually leads kind of really well into the next question I had, kind of about Buffett's franchise definition. So, a big takeaway I had from your book on the GEICO and Coca-Cola case studies was, his variant perception of these, robust franchise characteristics. So just for people not familiar with those characteristics, basically an economic franchise arises from a product or service that is 1, needed or desired, 2, thought by customers to have no close substitutes, and 3, is not subject to price regulations, unquote. So I just want to learn a little bit more about how Buffett's success has kind of interplayed with these franchise characteristics in terms of, do you think his biggest wins have come from franchise type businesses, or do you think he's been able to find success in other areas as well?
Yeah, I think the franchises are a huge part. So, let's just think about Coca-Cola. Warren said, this is, 20 years ago, he said something, if I gave you $10 billion right now, give you $10 billion, you couldn't unsee Coca-Cola. It's the number one manufacturer of concentrate syrup that combines with carbonation, makes soda pop. You couldn't do it. There's no chance. Okay. That's pretty interesting to think about, right? And then think about GEICO. Who's going to take their business away? For a long time, being an agentless direct provider of insurance products was taking market share from Allstate and Prudential and on down the line until Progressive came in and done a phenomenal job. Now GEICO and Progressive are going at it pretty hard. So you kind of look at like, who are you going to, who's going to come take your business away, or who could potentially come take your business away? So then let's look this, Warren doesn't own cloud, but I think cloud's pretty interesting. These hyperscalers, right? You think about these huge data centers, AWS, Azure at Microsoft or Google, and you say to me, okay, who's going to take this business away? If I gave you 10 billion, 20 billion, $30 billion, could you go take out AWS? No. I don't think so. There's not enough money for you to go get. Now, will there be more? Oracle's coming into the game. IBM's coming into the game. But if you look at how the market shares are changing, a little market share is changing, adjusting a little bit, but they're not going to go away. Is anybody going to disrupt Amazon as the world's leading online retailer? Can anybody do it cheaper and better?
Doubt it.
How much money do I have to give you to become the world's best at this? It's kind of like, really? Google search, with all the angst about Google search and everything that's going on. And we have, Bing at Microsoft, and we have Yahoo, and we have DuckDuck and all that. Google's still 93% market share. It's kind of like, okay, who else are you going to throw at me? So you kind of begin to think about who can take my business away. And I would have to say, Kyle, I probably spend more than half of my time reading and thinking about that. I mean, I read the balance sheets, I read the income statements, I read the quarterlies, I listen to the management, just to make sure that they're doing what I think they should be doing or what they said they would be doing. You can understand balance sheets and income statements relatively quickly and easily to see, where the levers are moving left or right. But I spend more time thinking about competitive threat and, who can take me out. And for a compounder, which owns a business that earns above the cost of capital, that is thought to be able to do that for a long period of time, that's what I spend most of my time thinking about.
Yeah, that makes complete sense. So I discovered the rule of one from reading the third edition of your book a couple of years ago, and I've really, really enjoyed using it. But I have had quite a bit of pushback on it that I'd love to get your opinion on. So I just want to give some background onto what the rule of one is in case people don't understand. So basically, it's the rule that for each dollar that a business retains, it should earn at least $1 of market value. And this is Buffett's rule. So just to give an example in the Warren Buffett way, you mentioned that Coca-Cola created about $1.02 in market value per dollar retained between 1974 and 1980. But when Roberto Goizueta took over, he elevated that to $4.66 between 1980 and 487, which is incredible. So just kind of getting back to the pushback, a lot of what I get is that the market obviously is kind of in charge of assigning prices to a business. So let's say that there is a business that is retaining a lot of earnings, but maybe it's not growing the earnings at a super high rate. It can still technically pass the rule of one if, let's say, the market's really euphoric and they're just driving up the price of that business. So I just kind of would love to hear your opinion on the rule of one as a tool for investors, and if you think it's still valid, and kind of how you would kind of hit back against that common complaint that I've got.
No, I've heard that criticism before, Kyle. I think it's legitimate criticism. I think what you have to do is put it in the right context. It was not meant to say that, $1 today in 2 years or 3 years or 4 years is worth more than $1 if you're in the middle of a bull market going straight up. That'll kind of skew the numbers. I think it was kind of meant over, a decade type longer, where you've gotten the fluff out of the market and maybe even been in a bear. People would say, well, if you go into a bear market, Robert, are you being unjustly punished because stock prices are down? Far worse than what the economic return. So let's just go back to first principles. The idea is that if you earn above the cost of capital, you're increasing intrinsic value. If you earn below the cost of capital, you're destroying intrinsic value. If you do either one of those things over a multi-year period of time, it should show up in the market value or the intrinsic value of the business. So if I'm consistently earning above the cost of capital by reinvesting above the cost of capital, every time I put $1 in the business, it should earn me at least $1, if not more, and vice versa. I think the criticism is let it play out, over a lengthy period of time. What I would say is that it really, shines a very, very bright light on bad businesses. If you're a bad business and you're high reinvestment, low margin, capital intensive business, and you're struggling to earn returns on capital that are below the business or own cost of capital, you can add up all the money that they've spent over 10 years. And if it doesn't show up in a dollars worth of market value, there's something really bad going on there. And I'll give you a perfect example. I was with Tom Russo, great value investor, great Berkshireist, super investor. And we were visiting Peter Kahn at the Wall Street Journal in the mid 1990s. And we happened to be in his office in New York. And, Peter had done a great job running the business, but the economic returns just weren't that good. And he flipped open the annual report and looked at the back, and there actually was a line that said capital investment for 10 years. And the Wall Street Journal was investing in a lot of crazy things. The internet was coming on, and, just money was just flying out the door because newspapers generate a ton of cash. I mean, they're not capital intensive, but he was finding a way to reinvest it in a lot of things. And Tom just very gently said, when I add up this line of capital investment that you've spent, and I look for the return of that capital investment, I can't find it in the price. And it was so illuminating. It was kind of like, yeah, where did the money go? What was the return on that money? And it's not in the price. There's a problem here. So I get the argument that when you're in a roaring bull market, it might be a false positive, right? That you're getting more for the bang of the buck because the market's going up multiples. But more often than not, it's a huge tell on a bad business. You just add up money of bad businesses that either put it into existing operations or bought other things in hopes of getting something better. If that doesn't show up in price meaningfully over 10 years, then that should be alarm bells. Stay away. So that's kind of how I answered.
Yeah, thank you for that. So final question. There was a great excerpt from your book, and this is from Warren Buffett. Quote, "So why do smart people do things that interfere with getting the output that they're entitled to? It gets into habits and character and temperament and behaving in a rational manner, not getting in your own way. As I have said, everybody here has the ability to absolutely do anything I do and much beyond. Some of you will, and some of you won't. For those who won't, it'll be because you get in your own way, not because the world doesn't allow you." So, I think Warren is a very humble guy. I think he's a genius, and I'm sure you probably agree with me there. So even though many of his attributes I do think are replicable by other people, maybe some areas of his temperament are, some aren't. But I kind of want to get your opinion on what do you think is the most critical attribute that Warren Buffett has that, if taken away, would have drastically changed his outcome?
Yeah, well, I think I like that way to finish up. I would say, Warren said, what I do is not beyond the confidence of other people to do the same thing. And that was really kind of the objective of writing the Warren Buffett Way. Warren says, what I do is not beyond the confidence of other people to do it. And we laid out all the methods and said, look, if you follow these methods, generally something good is going to happen to you. Then years later, he said, investing is easier than you think, harder than it looks. And I went, okay, there's a positive, right? Well, easier than you think was, and we talked about this earlier, you don't have to spend all the time worrying about the stock market and forecasting the economy, which nobody, in the last 3 years, nobody's been able to forecast this economy at all. You don't have to do that. You don't have to worry about the stock market. You don't have to worry about who's going to be president. I'll take that off. Take that off. You don't have to do it. It's so much easier. But the harder part than it looks is you own something whose price doesn't always walk lockstep in the stock market when it goes up, or sometimes it goes down in price. And there's the divide, right? That you get to the river, you get to the river and people go, I just can't cross it, right? So when I wrote the Warren Buffett Way, we were managing money. I've said this many times. I have never met anybody that I sat down with and said, this is how we think about investing. This is how Warren Buffett thinks about investing, stocks and businesses. This is what we're going to do. Do you think this would work for you? Do you think this is something you would like to do? 90% of the people said, yeah, I'm in. In about 3 months, 3/4 of those people have already lost their mind. Oil's going up, Robert. How come we don't own oil stocks? Oh my God. Well, you need to sell this over here. It's not doing it. It's the cycle. The harder part is the temperament part, right? The harder part is the sound-mindedness. The harder part is disassociating yourself from the stock market. If you said to me, what is the single one characteristic that has made Warren Buffett successful? It's been his purposeful detachment from all things that are the stock market. just divorced himself emotionally, mentally, whatever. It's not there. It might as well be up at Jupiter and Mars. It's not there. He owns a business, and that's all he thinks about. The rest of us, that's all we do is think about it. And we don't think enough about the business that we own. And when you look at it in that glaring light, that's probably the single biggest reason. What Warren doesn't think about, we're all consumed with. What he does think about, businesses, we don't spend enough time thinking about.
Love it. Robert, I just want to say thank you so much for coming back on the show. Had an amazing time as usual. Where can the audience learn more about you and your books? And I also know that you will be in Omaha for the Berkshire annual meeting. So if you have any events that people can attend, please feel free to share that as well.
Well, the book is pre-ordered on Amazon. I think pub date is April 23rd. You can pre-order it now. I think it is a compendium of everything that I've written about Warren these last 30 years, studying him last 40 years. It will be in Omaha. There are lots of great events out there. I think Bob Miles has a great event called the Value Investing at the University of Nebraska in Omaha. You can reach out to Robert P. Miles. He also was an author of books about Warren, and has done a great job. Lots of conferences, but no day will be bigger than that Saturday. And I'll be there, front and center with my diary, opening it up and pinning it down. So it's the best part of my year. I go out Monday and stay the entire week. I can't get enough of it. It's like a kid at Disney World. I just can't leave. I want to stay the whole time. So, and I know you'll be out there, Colin. I know we'll get a chance to catch up with each other. So, one, thank you as always for your wonderful invitation, and thank you for a great conversation. You do a great job prepping, and your questions are always very thoughtful. So, thank you.
In 2023, they generated $37 billion in operating earnings. The stat that sort of just blew my mind at the meeting is they put that in terms of daily earnings they're getting. They're getting $100 million per day that they have to figure out how to allocate it. So capital is just constantly flowing in faster than they're able to deploy it.